You have probably never read your car insurance policy. It is not a document that rewards attention. But in July, one American insurer started mailing out $5 billion. It went to more than 49 million vehicles, about $100 apiece, and it arrived with one very specific word attached: dividend. A dividend is not a discount. It is a share of the profits paid to the people who own the company. So here is a question worth asking. Do you own your insurance company? Tens of millions of Americans do, and almost none of them know it. This already happened in 1752. The document that explains those checks is 274 years old. It is written in 18th century legal English, and buried in it is a single clause that accounts for all $5 billion. That same clause, read in its own word order, explains why the same brand spent last year raising rates on a different set of customers and quietly moving $400 million to keep that side of the business standing. Same name, opposite direction, 9 months apart. Hold on to that. Philadelphia in 1750 was built almost entirely out of wood, heated by open fire, lit by open flame, and packed tight along the Delaware. Fire was not a risk there. Fire was a certainty with an unknown date, and when it came, it did not damage your property. It deleted it. No recovery, no claim, no adjuster. There was the smoke, and then there was the rest of your life. A printer named Benjamin Franklin had already tried to do something about the fire itself. In 1736, he organized the Union Fire Company. 30 men, leather buckets, a standing agreement to run toward each other's houses. It worked. Philadelphia got very good at putting fires out. It did nothing about what happened to you afterward. So, in 1750, Franklin and the men of that fire company tried something more ambitious and failed. They tried again the following July, and on the 25th of March, 1752, a deed of settlement was signed for a thing with an almost aggressively boring name: the Philadelphia Contribution Ship for the insurance of houses from loss by fire. Here is where the popular version goes wrong. Franklin did not found American insurance. Charleston beat him by 17 years. Its friendly society insured houses against fire from 1735 until 1740, when a fire burned through Charleston and took the friendly society with it. London's Hand in Hand had beaten them both in 1696. And Franklin was not the first name on his own document. The governor signed above him. He was second of roughly 1,800 signatures, collected on 15 feet of parchment. What he was the prime mover, one of 12 original directors and president for 2 years. A smaller claim than the legend, also the true one. The thing that matters is not who signed it. It is what it said. The deed did not describe customers. It described members. Every subscriber, it said, would be equal sharers in the losses as well as the gains and advantages. Read that word order again. Losses first, and then, a few lines down, the mechanism. The net profits shall be divided yearly to every member in proportion to his insurance, not a rebate, not goodwill. A division of profit among owners, written into the founding document in 1752. The directors, incidentally, were forbidden from taking any stipend, salary, gratuity, or allowance. They ran the thing for nothing. Why build it that way? Because there was no other way to build it. Colonial Philadelphia had no stock market and no investors willing to fund a company against a risk nobody had ever priced. What it had was a volunteer fire company, 30 men who already trusted each other to run toward a burning building. The mutual was not an ideology. It was what you get when the only capital available is your neighbors. And then there are the fire marks. Members nailed a small lead plaque to the front of the house, 4 hands clasped at the wrist. You have heard what those were for. The story is that firefighters would arrive, look for the mark, and if it was missing, stand in the street and watch the house burn. It is a very good story. It is not true. The contemporary record runs the other way. Daniel Defoe, writing in the 1690s, described firemen turning out to houses insured and uninsured alike. London's fire offices instructed their men, in writing, to attend every alarm. Charleston fined anyone who refused to help fight a fire, any fire. The marks were advertising and proof of coverage and a quiet warning to arsonists. They were not a death sentence for the uninsured. Myths about money almost always flatter the cynic. This one has been doing it for 300 years. Move forward 170 years, from a burning city to a muddy road. In 1922, a retired farmer from Merna, Illinois, named George Jacob Meckerl, decided he had a complaint worth building a company around. Farmers were being charged what city drivers were charged. They drove less, they crashed less. They were paying for somebody else's risk. So on the 7th of June, 1922, he set up an auto insurer owned by its policyholders. By the company's own account, that was the entire point. He called it State Farm. 104 years later, that structure produced a check. Here is the machinery, because the machinery is the story. In 2023, State Farm's auto business lost $9.7 billion on underwriting. Crash repair costs had gone vertical. By 2025, the same business made a gain of $4.6 billion. That is a swing of roughly $14 billion in 2 years. In a shareholder-owned insurer, a swing like that belongs to shareholders. There is no third option. In a mutual, there is nobody else in the room. So in February, the company announced the largest dividend in its history, $5 billion, and at the end of July, it started paying. 4 to 10% of premium paid during 2025, the percentage set by how each state contributed to the result. Average about $100 across more than 49 million vehicles. Georgia's insurance regulator put his state's share at roughly $279 million, about $135 a vehicle. That word, dividend, is doing legal work. Regulators define a policyholder dividend as a refund of part of your premium out of the company's surplus. Federal tax law is blunter. It cannot be fixed in your contract. It depends on the experience of the company or the discretion of its management, which means it can never be promised. Only paid, but the numbers run in a strange direction. In life insurance, the mutual really did die. Mutual companies held roughly half of the American life industry's assets in 1990. By 2024, they held about a quarter. In property and casualty, the insurance on the car and the house, it went the other way. Mutual share of premiums rose from 38% in 1984 to 44% 30 years later. Today, mutuals write most of the farm policies in this country, most of the homeowners policies, and a majority of personal auto. So the question is not why mutuals died. It is why they died where your savings sit and survived where your car sits. The answer is that somebody bought them. On the 1st of February, 2000, John Hancock converted from a mutual into a stock company and sold 102 million shares at $17 each. About $33 in today's money. Its policyholders had to choose, take shares or take cash. About 3/4 took the cash. Within a year, the stock was up 107%. MetLife did the same thing 2 months later on a far larger scale. Prudential followed the year after. The academic work here is more generous than you would expect. The peer-reviewed studies find efficiency rather than theft, and the policyholders who held the stock did fine. But read what that research measures. It measures the people who held the stock. For the 3/4 who took the check and walked away, there appears to be no peer-reviewed study at all. And here is the turn. The reason a car insurer could mail out $5 billion this summer is not that it is generous. It is that membership in a mutual is the one financial interest you are not permitted to sell. You cannot trade it. You cannot cash it in on a Tuesday because the rent is due. It has no market price, and that is precisely why nobody was ever able to buy it out from under you. The thing that makes it worthless in your hands is the thing that keeps it in your hands. Now go back to that deed and read the order of the words. Equal sharers in the losses as well as the gains. Losses first. In 1752, they put the bad news in front. Because ownership is not a gift, it is exposure. In May of 2025, a California subsidiary called State Farm General, a separate legal company from the one now mailing out auto dividends, was granted an emergency 17% increase on homeowners' rates. The state's own finding described extraordinary financial distress and surplus depletion that threatened the business. The condition attached was $400 million in cash from the parent. So, $400 million in, $5 billion out, 9 months apart, the same name on the truck. That is not hypocrisy. It is two companies, two books of business, two very different risks, and one of them is not working. And when a home insurance market genuinely fails, the bill does not evaporate. In California, when the state's insurer of last resort ran short after the 2025 fires, insurers were assessed $1 billion and were then permitted to recover half of it from their own policyholders. Owning the upside means owning the invoice. So what does a 274-year-old deed tell you to watch? 3 things, and not one of them is a prediction. First, the word itself. Whether an insurer is a mutual is not a secret and not a judgment call. It usually sits in the company's legal name. Most people who own an insurance company have never looked. Second, the direction of travel. That dividend was funded by a $14 billion swing in one book of business in 2 years. Swings that large are not stable, and they run both ways. The company has said plainly that the payment is retrospective and does not affect future rates, which is a polite way of saying it is not a rate cut and should not be read as one. Third, the split. Mutual ownership is retreating from the products where money sits for 40 years and holding firm on the products people renew every 6 months. That divergence decides who, if anyone, is ever sent a share of a good year. The instrument from 1752 still works. It pays out when experience beats expectation and the surplus is strong, and when the book loses money, that same instrument does not send a check. It sends a bill. You still do not have to read your car insurance policy, but somewhere in it there is one word, mutual or not, and that word decides whether you are a customer of the company or one of its owners. In 1752, 1,800 people in Philadelphia signed 15 feet of parchment to make certain they would be the second thing. Most of the people who inherited that arrangement have no idea they still are.